Welcome back, everybody. A couple of weeks ago, I talked about 3 things I wanted to do better with my portfolio in 2024. I wanted to focus more on companies that met my personal strategy. I wanted to ignore general macro concerns or issues for my long-term holds, and I wanted to be more patient about when to buy to take advantage of unexpected dips. Well, we're only 3 weeks into 2024, and I've already deviated from my personal strategy a little bit and adding my first new company in the new year. And that's because it has the following high-level stats. It doesn't pay a dividend. It has an 80 PE ratio, and is coming off a year where it returned 77% at an over $1 trillion market cap. So, of course, the company that I just added is Amazon. And your first thought might be, oh my goodness, here he goes again, buying a big tech company at the top because of FOMO. But in this video, we're going to break down my thought process on Amazon, why I believe it's still poised to outpace the market in the long term, even at these prices, and why from a valuation perspective, I think it's actually quite a bit cheaper than it looks on the surface. And you might not know that I actually talk about these ideas and stocks that I'm researching in my weekly newsletter. It gives me a chance to put some thoughts together and share what I'm doing outside of just making videos. And I've been talking about Amazon in the last couple as I've been researching it. Plus, it's completely free. So if you're interested, just go in the link in the description to sign up. Okay, so let's dig into Amazon, and we'll just take a look at some basic stats first. Amazon is trading at $155.34, and over the past year, they've returned over 65%, which is over double the S&P 500's return. Now, if we look at some basic valuation metrics, this is where you're all going to start cringing because Amazon is trading at an 80 PE ratio and a 22 price to cash flow ratio. But even that's a little bit misleading because it's just operational cash flow, meaning that it doesn't actually account for the CapEx spend or stock-based compensation, which for Amazon are both high. So their price to free cash flow minus SBC is still going to be quite a bit worse than this. In general, though, the price to operational cash flow measure has been on a downtrend over the past few years, and it just shows how much cash flow Amazon's actually generating. So that definitely is a positive. But when you see the type of numbers that the traditional value method spit out, it's definitely not pretty. And I think that's been one of the challenges with trying to understand value when it comes to Amazon, at least for me. Because a lot of the tools and methods we normally use don't really work on the company based on how they operate. And I'm going to show you what I started looking at that gave me a slightly different perspective here in a minute. But first, let's dig into Amazon's business. So how does Amazon actually make money? Amazon's revenues are broken down into 3 major segments. You have North America and International, which both include revenue from online and physical stores, third-party seller services, subscription services, and advertising services for the 2 different geographic regions. And then the third segment is AWS, which obviously includes the sales of compute, storage, database, and other services for customers using the AWS platform. And if we take a look at how the revenue and profits align to each segment, for North America, they did $315 billion in net sales in 2022, which is the last full annual report that's available, which represented 61% of their total revenues. But it actually had an operating loss of $2.8 billion, so it wasn't even profitable in 2022. Now, if we look at International, it did $118 billion in net sales in 2022, which represented 23% of their total revenues. But they also had an operating loss of $7.7 billion. So again, that segment wasn't profitable either. And then for AWS, they had $80 billion in net sales in 2022, which represented 16% of their total revenues. And they had an operating profit of $22.8 billion, which obviously accounted for more than 100% of Amazon's actual profits in 2022. Now, a lot of the reason why Amazon's store segments weren't profitable in 2022 was the amount of investment for scale that they had to make because of the crazy growth that they saw in 2020 and 2021. And you can see the significant increase in R&D spend over the past 2 to 3 years as well. And we're going to come back to that R&D spend when we talk about valuation here in a minute, but let's take a look at their growth per segment to understand a little bit deeper about what's going on. And now if we break down the growth rates by segment, going one level deeper, we can see that it's broken down by stores, third-party sellers, subscriptions, advertising, and then of course, AWS. And we see that in their annual report for 2022, it broke down like this. For stores, it was actually negative growth, just less than 1%, but still negative. For third-party sellers, it was 13.9%. For subscriptions, it was 10.9%. For advertising, it was 21.1%. And for AWS, it was 29%. And now if we look at their most recent quarterly report, we see the following. For stores, the growth rate is 4%. Third-party sellers, 18.6%, subscriptions, 14%, advertising, 23%, and AWS, 13%. So all of the non-AWS segments have accelerating growth compared to where they were 9 months before. And the highest margin segments in that group, which are advertising, subscriptions, and third-party sellers, have the highest growth rates. Now, obviously, AWS having a slower growth rate might be a concern on the surface, but it's still double digits at this point. And one thing that this highlights to me is that Amazon isn't just a wide moat business. They have wide moats in multiple business areas. And that's because they have significant moats in e-commerce, including distribution and delivery, cloud infrastructure, which is AWS, and then advertising platforms for both their e-commerce marketplace and streaming. Now, obviously, we understand that Amazon is a big tech company and they have a similar ecosystem and moat profiles, but one thing about Amazon that's interesting compared to their peers is that they have this market-leading e-commerce and distribution business. Obviously, it's very capital intensive, but it's also a differentiator in terms of them having ad platforms that are driven by actual commerce as opposed to search or social. And it also allows Amazon to showcase the scale and effectiveness of their cloud and AI business to meet customers' needs because they're using it themselves. And so what I take away from that as an investor is that one, Amazon still has room to grow. And I mean both in top-line revenue as well as margin expansion, because their higher margin products and services are growing at over double digits and accelerating. Their large-scale retail business that was unprofitable about a year ago is now profitable again and continuing to improve. Plus, their mix of e-commerce, cloud, subscription, and advertising revenues is arguably the most diverse amongst the big tech companies. But at a minimum, their physical logistics and distribution network is extremely unique, and I didn't even talk about Whole Foods at all. Okay, so let's talk about risks. So for the first one, I'm just going to say it's regulatory and antitrust concerns. Now, primarily what I'll discuss is Amazon and the FTC, or the Federal Trade Commission, who have multiple lawsuits ongoing in an attempt to prove that Amazon has used unfair practices. Now, primarily led by FTC Chair Lina Khan, who has gone after multiple big tech companies already and at this point has lost, but is known for her 2017 article published in the Yale Law Journal about how Amazon is a monopoly. Now, I read through the FTC claims on their website, and to me, they seem like pretty normal competitive practices, but of course, I'm biased. I'm an investor in Amazon, I'm an investor in Apple, and you guys know how I feel about the whole Apple App Store kind of controversy, and I feel the same way about Amazon. I think these are companies that have built industry-leading marketplaces, and there's a specific price to pay if you want to get in front of their audience. And I know not everybody likes that, but for me, it's one of the reasons why I invested in these companies because of their market dominance in those areas. Now, in terms of the lawsuits and where they're at, Amazon has asked the judge to throw them out, but we'll just have to see how they progress. Now, regulatory concerns are always challenging because you just don't know how they're going to end up. But at this point, it's just something that I'm watching and I'm not overly worried about. Now, risk number 2, declining market dominance by AWS. Now, AWS is arguably the most critical revenue stream for Amazon since that's where most of their profits are coming from. And while they're still the market leader, Microsoft and Google have started to grow their market share. Obviously, with Microsoft being the largest investor in OpenAI, the partnership has created a lot of excitement in all parts of their business, but especially with their cloud offering. And Google's progress in cloud and with their AI/Bard chat is also something that's gaining momentum as well. But Amazon isn't just staying put either. They're creating their own custom silicon for training and inference. They've partnered with Anthropic, that's a leading large language model maker, or LLM, to use AWS as their primary cloud provider, and they'll be using Amazon's chips to build, train, and deploy their future LLMs. They've also introduced Amazon Bedrock, which is going to be an LLM as a service provider, allowing companies to integrate and try out different LLMs instead of needing to make direct integrations themselves. And they've done some other things as well, but with the idea that Amazon themselves are going to be using the services to make their own e-commerce business better as they go. So obviously, cloud and AI is going to be an extremely competitive part of their business, but I think Amazon's starting from a position of strength, and we'll just have to see how it progresses. And then risk number 3, saturation and size. Now, this just means that Amazon is already at a size, both in their overall market cap as well as their market penetration, that maybe sufficient growth to justify their valuation just isn't possible anymore. But like we mentioned before, Amazon has growth opportunities both in the top line revenue and with margin expansion. Their critical business segments are all in industries that are still growing. With e-commerce, Amazon is by far the market leader, but overall e-commerce is still growing at double digits a year. With cloud and AWS, again, Amazon is the market leader, but the overall space continues to grow and will even accelerate with AI. Amazon's other three business segments with the highest growth rates, advertising, subscriptions, and third-party sellers, are some of their higher margin segments in their mix. And as those continue to grow, profitability should grow with it. And then lastly, Amazon continues to work on improving efficiency with fulfillment. Shipping is their largest expense, and they made great strides in 2023. They completed a change from one national single fulfillment network to 8 regional ones. This is reducing costs while improving delivery speeds for customers. And while they've seen benefits from it already, it's just getting started. So while Amazon is definitely a large company with a lot of customers, I still think there's a lot of opportunity for growth going forward. All right, so let's talk about valuation. If we just look at traditional valuation methods here, it looks terrible because these methods use price to earnings ratios, free cash flow calculations, and like I mentioned in the beginning, Amazon never looks good when you evaluate it that way. And honestly, that's one of the reasons why I stayed away from Amazon as a stock, because I didn't really understand how to value it, at least with the way that I was valuing things. But I read this article on Seeking Alpha and it got me thinking about Amazon's R&D spend and how as an investor, I should be evaluating that number. And this is what I was breaking down in my newsletter last week. Basically, Amazon and all the big tech companies use R&D spend as a way to invest into their business for the future. Now, actually, Amazon calls this technology and content spend, but it rolls up to the R&D category when you look at it on websites. But the reason why this is important is because those expenses get taken out of their number before net income. So earnings are lower than they would be if it wasn't categorized as an upfront expense. Now, what I mean by this is that a lot of times companies invest in the future with either capital expenditures or retained earnings. Both of those numbers come effectively after net income is calculated. So things like earnings per share are higher in those cases, whereas when you're taking that spend out up front, it reduces earnings. Now, I know there are tax benefits for doing that, and it's not quite a one-to-one relation in terms of what they're spending that money on, but I started to look at that R&D spend more like retained earnings that are being invested for future revenue, and I calculated what their PE ratio would be like if that was the case. So for each of the Magnificent Seven companies, I basically just treated R&D spend as earnings and recalculated their PE. Now, I know this isn't realistic, and I didn't even account for the additional tax hit, which would reduce those earnings, but I just wanted to get an idea of what it would look like. And as you can see, the adjusted PE ratios are quite a bit different than the current ones, which should be expected. Now, do I think Amazon is really at a 15 PE? No, of course not. That's an extreme example. But to get a more realistic view, I calculated what percentage of net income each company spent on R&D. And as you can see, Amazon spends a much higher amount on R&D versus net income than their peers do. So then I calculated what Amazon's PE would be if they reduced R&D spend to where their peers are and then just made the rest earnings. In that example, I used about 40%, which would still be higher than Apple or Microsoft. And when doing that, I came up with a PE of about 25. So again, this is just a theoretical exercise. I'm not saying that this is the right way to value this company. I mean, at the end of the day, I just moved a number around. But I think what's important is that R&D spend is money that's being invested for future revenue. And so as a shareholder, I do think it has value. And it's something that I'm going to start looking at anytime that I'm trying to understand how cheap or expensive a company is. And ultimately, if Amazon was there sitting at a PE ratio of around 20 to 30, I think a lot of people would have a very different opinion on how expensive it was. So of course, not everyone's going to agree that it's appropriate to do this, but this is part of what makes stock analysis and valuation interesting, because we all have different perspectives and we all have to decide for ourselves what's the right way to value a company. All right, so let's rate Amazon using the 3 criteria I use to evaluate stocks: business, operational performance, and valuation. So from a business perspective, Amazon has multiple wide moats in growing industries. They're a market leader in e-commerce as well as cloud, and they are the fastest growing advertising platform in big tech. Amazon's also a logistics and distribution leader, so obviously from a business perspective, I would rate them as good. In terms of operational performance, profitability and margins continue to improve, but I would argue that they're probably not great yet. They don't really buy back shares or provide dividends because they're constantly reinvesting into their business. Ultimately, that should be good for investors, and historically it has been, but that'll end up showing up more on the business side of the equation. Amazon also has regulatory and antitrust concerns going on, and we'll just have to see what happens with those to know what the impact's going to be. Lastly, they do have some labor and union issues, which I didn't really talk about much, but that also could be a lingering concern. So from an operational performance perspective, I would rate them as okay. So lastly, in terms of valuation, if you're looking at the traditional value models, they're going to be terrible. And if you're looking at price to earnings or even price to free cash flow ratio, they're going to be pretty bad. But if you evaluate based on adjusted PE, when I talked about backing out R&D spend, or even if you look at price to operational cash flow, it shows that it might not really be as expensive as it looks. So from a valuation standpoint, I personally would rate them as okay because I'm viewing it from that lens. But obviously, if you want to stick to the more traditional valuation models, then the valuation rating would definitely be poor. But again, this is why stock analysis and valuation is very much a personal exercise because we're all going to have our own view. Now, overall, Amazon was a fun one to dig into because their business is pretty diverse and trying to value them isn't as straightforward as most stocks. But as you guys know, I've talked about many times, I might evaluate stocks on these 3 criteria, but I've always said that the most important one to me is business. If that part is good, I can deal with issues on the other 2. And if you watch this channel, you've seen me do that over and over again with the companies in my portfolio because I just believe that the best businesses will win over the long term. And the other stuff is just a point in time situation that hopefully gets resolved. So I'm excited to add Amazon into my portfolio, and one that I'm honestly probably not going to think about very much because it's going to end up being in that group with McDonald's, Apple, and Visa, where I'll always want to add more whenever it dips. But I tend to get excited every time I add a company to my portfolio, and I'm not always the best at following my own plan, as you guys know. So we'll just have to see. But what do you guys think about Amazon? Is it something that you're holding in your portfolio already, or is the fact that it doesn't pay a dividend or that it's at an 80 PE holding you back? Let me know down in the comments below. Now, if you want to know more about how having a personal investment strategy can help you pick stocks, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins. And I'll see you guys in the next one. Peace.